And so this is what we got to do, right? We simply have to follow this math-based approach in order to outperform just buying and holding GRT, buying and holding graph. We can actually outperform simply by following these rules, simply by doing. Hi, in this video we're going to talk about TheGraph, ticker symbol GRT, currently at market rank 49 and the best performing cryptocurrency among the top 100 in the last 24 hours. The graph went up by 16.3%. It's currently at 42 cents and it has a market cap of almost $2 billion. Now in this video, we're going to look at a math-based approach in order to outperform just buying and holding the graph, because we can see there is quite a bit of volatility, right? The graph at some point in time was over $2 and then went all the way down to 34 cents, 32 cents even. So you want to time this somewhat. You want to be buying when momentum is positive, and you want to be outside of the market when momentum is not that positive. So what's a good approach to time this? I think there's several ways to do this. A most straightforward way is to simply look at relative valuation. So one way to do this is to, instead of looking at this US dollar chart, to look at outperformance versus Bitcoin and Ethereum. Because in the end, what's the reason? Why do you actually buy any altcoin? Why do you actually take on more risk than simply just going into Bitcoin? The reason is you want to outperform Bitcoin. There is quite a bit of correlation between cryptocurrencies, right? So when Bitcoin is going up and Ethereum is going up, a lot of other cryptocurrencies go up as well, and vice versa. When there's a crash, everything is crashing. So since they are moving in the same direction anyways, we at least want to be better off taking on more risk. And the graph obviously is more risky than Bitcoin. And so let's look at this. Let's look at GRT versus Bitcoin. And this chart shows a pretty different picture to the US dollar chart, right? The US dollar chart has temporarily quite a few interesting rallies of like 150%. Of course, the initial rally here was very, very impressive, right? 1,750%. But sometimes we get these nice, more or less short-term rallies. But once we look at the Bitcoin chart, this looks a little bit different. It looks like most of the outperformance really happened in the early days, and since then we had a pretty constant decline. Now I prefer to compare the altcoin to Ethereum, and that's because Ethereum is more or less the mother of all altcoins, right? Bitcoin is kind of like the digital gold, right? It's not necessarily 100% comparable with something that incorporates technological superiority, right? So a lot of altcoins, they are a technology play. Bitcoin isn't necessarily. Bitcoin is rather digital gold. We are rather betting on long-term adoption. We are betting on the macro environment, right? How much is digital gold going to be in demand in the future? That's not so much for the altcoins. For the altcoins, we are rather betting on technology superiority, on network effects. And so this is now the graph measured in Ethereum. And this, I think, has a way clearer picture. So look at this. We did have quite a bit of volatility in the beginning, right? Again, a rally of like 400%, then the other way around, a crash of 75%. And since May of 2021, we have a pretty constant bleed versus Ethereum. So I think this picture is very, very useful. Currently, the upside, in case we stay in this channel versus Ethereum, is only 12%, right? The downside is way higher. The downside is maybe 30% or so. So that's why it makes sense to look at relative valuation graphs. If you just plot the price in US dollars, that kind of a dynamic isn't that obvious, right? It might look more like we are somewhat finding another floor. Like we have found a floor here, got another rally. Now we might be seeing another floor. But once we see this in relative terms to Ethereum, this is a pretty clear, constant underperformance. Now there are ways though to protect yourself from this, and that's trading according to moving averages. And we don't just want to trade randomly, right? So what you can do here on tradingview.com is you can click over here and you can add the moving average. And when you do this, you get this thin blue line. You double click on this, you can change the formatting somewhat. So let's maybe make this in red and thick. And then what you can do is you can change the duration of the moving average. So you can say, maybe I don't want the last 9 days of prices to be average in order to get such a point. Maybe I want to look at more prices, thus smoothen out this line more, right? If you take, say, only 5 days, then this moving average is moving quite a lot, right? It's going up and down. It's pretty much following the short-term fluctuations. But once you smoothen this out more and more, and once you look at, say, the 50-day moving average, this is a way clearer picture. And one might argue, maybe we want to trade according to this. So maybe we want to be in the market whenever the price is above the moving average, right? That's when the momentum is bullish. And we want to be outside of the market when the price is below the moving average. So we're just simply in cash. That's how we could protect ourselves from such a crash, right? Something like this, 70%. And then we can simply wait it out and buy whenever we go above. The problem though is what kind of a duration here is optimal. Should we trade according to the 50-day? Should we trade maybe according to the 30-day and react a bit quicker, but then also trade in and out more often? What's the perfect duration for following such a strategy? And it's not super straightforward to find this out. You actually need to run a simulation. You need to run a simulation of buying and selling. You need to do something that's called a backtest. And that's what I've actually done. That's this table over here. Now let's start with something else first. This is the historical development of that simulation. So in white, we see the graph price, the GRT price. Note that it doesn't start at the very beginning over here, right? When we look at this price development, we had quite a bit of spikes and crashes and other spikes again. This chart over here only starts with the last spike. The reason is, in order to do this kind of a backtest, in order to do the simulation, we need to get a minimum set of data. And what I have done is I've looked at all the moving averages from duration of 1, so basically just looking at yesterday's price, all the way to 52 days. So our chart starts actually here, because before the 52nd day, we can't calculate the moving average, right? We need 52 days of price data in order to calculate 1 point here at the moving average. So this is where our trading starts. And so when you look at the graph's price, so maybe let's take the US dollar price because that's what I've actually backtested. When you look at the graph's price from the start of this moving average to today, we actually see some kind of a loss here. So that's what we are seeing over here. We see the price starts here and it actually went down since beginning of our backtest. Now this is the graph price in white. In green, we see our backtest and we see sometimes we are outside of the market. Sometimes we are just in cash. And we do protect ourselves somewhat from those crashes, right? Look at this. We were completely in the market when we had this bull run at the very beginning, but we did protect our gains somewhat by getting out of the market when momentum turns bearish again. Now there's two ways to backtest this. One of them is with the simple moving average, SMA. The other backtest is done with the exponential moving average, EMA, which actually worked better. So what you can do is, instead of using here the simple moving average, we can go again to trading view and we can enter the exponential moving average. Now what's the difference between the exponential and the simple moving average? The difference is the simple moving average just takes every day in those, say, last 52 days, and it gives the same weighting for the price of every single day. Now that's different for the exponential moving average. For that, we take more weight for the recent data. So the data that happened, the prices that happened 52 days ago get way less weighting. So it's a bit more reactive to the price movements. And so when we compare this, right, let's maybe add the exponential moving average. Let's also give it the same duration of 52 days. And of course, adjust the styling somewhat. Let's maybe make this blue. Then we can see the blue exponential moving average. It works a bit quicker, right? It's closer to the price because simply it weighs the recent price data a bit heavier. And so for the graph, this exponential moving average actually worked the best. Now, what's the best duration over here if we wanted to trade according to that strategy? That's the results of this table over here, but we also got this in graph format. I think let's look maybe better. So let's maybe start here with the simple moving average. So here we've got the buy and hold line, right, which is negative. So we would have had a negative return over the entire period since we only start trading around here. So that's a negative return in that time frame. So that's what you see over here with this black line. It's below 0. It's a negative return. But when you look at trading according to a simple moving average, you would have gotten a better performance. Most of the time you would have actually made money. Sometimes that strategy is below 0, but most of the time when you just trade it according to that simple moving average, depending on your duration, you outperform. So on the x-axis over here, we see the duration of the moving average, right? So 1 is simply looking at yesterday, 52 is looking at the moving average trading performance using the 52-day moving average. So that's an annualized performance of a bit under 20%. And so if we trade it according to the simple moving average, 34 or 35 worked the best. It would have given us 40% positive annualized return rather than negative 43% or something like this. So this is the moving average you should take, the 42 simple moving average. Now, as said, the exponential moving average actually worked better here. So this is the 34-day simple moving average. This here is the return of the exponential moving average. And let's look at those results. The best exponential moving average in terms of trading return is over here. So you want this kind of a moving average when trading. This is simple moving average and exponential moving average combined. So both of those strategies, they tend to outperform buying and holding. They are especially good once you go beyond, say, the 30-day averages. That's when you consistently outperform just buying and holding, and you also outperform the 0 line. So you actually make money during a market while the graph itself, buying and holding, would have lost you money, right? This is pretty good. We start over here, we end up over here, we make money. This is different to the person that just bought and held during this entire bear market. And so let's plot that, right? Let's plot the 41-day exponential moving average here on this interactive graph. But before we do this, if you so far enjoy this kind of content, feel free to subscribe because I publish videos regularly. Of course, a like would also be appreciated. That would help the algorithm and it will help the channel grow. Thank you. Now the 41-day exponential moving average. So again, we go to trading view. We adjust the length over here and this is what we get. A very nice following of the bull market and a very nice exit for the bear market. It even acts as a resistance sometimes or as a support during those times. And we had been below this moving average for quite a while. But now with this recent rally, we did go above this. On the 15th of March, we have crossed this moving average, indicating that it might make sense to buy now GRT to get on the current positive momentum. That being said, right, it's only one of many approaches. It did outperform buying and holding as stated. It is better. But if you ask me, am I going to buy GRT right now? I for now hold off because of this chart over here. So I want to see this kind of a long-term negative momentum to turn around. I want this resistance here to be broken first. I don't really like to buy into such a trend and especially into such a trend where we are already comparatively high. So the question is always, when opening a trade, what's your target, right? How long are you going to hold? When are you going to sell? When are you going to limit losses or take profits? And you want to make this decision before you actually already open the trade, because deciding this spontaneously is very unlikely to do you any favors. There's a lot of psychology involved, and right, when we are in profits, people just get greedy. When we are in losses, people are so fearful, they simply hold on and hope for the recovery. So you really better have some kind of an idea before actually buying under what conditions you are going to sell. And when I look at this graph, I would feel inclined to sell just after an outperformance versus Ethereum of a few percentage points. Depending on how quickly this goes, this could be 15%, maybe 12%, something like this. This is where I would feel uncomfortable holding the graph. Thus, this trading signal here, even though it says it might make sense to follow the price movements now, I think it might still be somewhat dangerous. This is of course no certainty, right? I don't have a crystal ball. I can't say where the price will go. I simply try to use mathematics in order to get the best risk versus reward. I try to look at approaches that tend to work historically speaking. And so that's my current impression of the price action. Of course, this has to do also with your risk tolerance, right? I'm not going to say don't buy into GRT and then in the end the price doubles and triples again and then you're blaming me. So I simply probably have a lower risk tolerance than you. If you decide to buy right now, I simply want to see the overall momentum to turn around first before I feel comfortable getting into GRT. Now, all of these backtests, all of these buying and selling simulations, they have been done with Microsoft Excel. There's no real magic around here. I've built something that you can download yourself. There's all the price data, there's all the calculations. You can simply change the duration of the simple moving average. So say you change it to 15, and then you can see over here what would have been the result of that graph. I've also made a tutorial on how to build such a backtest. So in case you want to change the approach somewhat, or maybe do this for another altcoin, then you can get all of this. This is at thebitcoinstrategy.com. The link is also in the video description. So this is the premium membership with various tutorials on how to create those backtests. Or over here in the statistics library, we've got the different Excel sheets that you can download. Now, if you don't want to go through all of that yourself, you can also simply just ask me here in the premium Telegram group. So simply pick the altcoin of your choice. I do one specific backtest for the premium members every day. So that's where you can reach me. The premium chat, this is where I've just done, for example, the backtest here on the graph, but also, for example, here for the NEAR protocol, which was a request by one of the premium members. Now, you definitely want to look out for what Bitcoin is doing, right? Because all altcoins, including the graph, are very highly correlated to Bitcoin. Bitcoin is falling, the graph is likely going to fall as well. So a current analysis, an on-chain analysis, looking at various statistics on Bitcoin, where Bitcoin is currently headed, that's over here in this video. So there's a lot of value there. Hope you will enjoy that. See you in that video. Bye bye.